And Disney stock is slipping today, and that's really hurting the Dow. Company failing to meet its revenue projection, even though profit last quarter was better than expected. Doug Flynn, Flynn Zito Capital Management. I'll need some of those gummies if this keeps up in the market, right? Thank you, Doug. Right?
Absolutely.
What about, so tech first, then Disney. So the tech stuff you and I have talked about, because last time you're on, and now it's not over yet, whatever's going on.
No. So that's continuing a little bit, but you also have the expectations for a rate cut have dwindled a lot, and so that kind of shook the market a little bit when you add those two things together. Some profit taking on perhaps the profit projections in the AI space, that's driving tech down, and then maybe we're not going to get that cut in December because they're backtracking a little bit on that. We're not going to have the data, so they're worried about that. So you have a day like this. Overall, not a big deal in the grand scheme of things. You're still within the 5% off of the highs, so that's really nothing, and a little consolidation is not the worst thing. It's really what happens beyond that you really start to worry about.
What's going on at Disney?
Yeah, Disney, had some good things like with their streaming. Their Disney Plus and Hulu did great, but their ESPN and their traditional TV with the ad revenue, that just continues to get worse. And so the market, look, they came out and this is rare, they actually raised their dividend next year by 50%, which typically a stock will raise it a little bit. That's a big jump. And so, but the market didn't care. They were looking beyond that in some respects, saying, not even benefiting from that thing. But the market's punishing it today, and it has a lot to do with the fact that they also have this battle going on with YouTube TV, which is the largest live TV streamer in the U.S. now, with over 10 million users. And it's estimated that it's costing Disney more than $4 million a day by not being on there. So they got to work that out. So this isn't a long line of things that they need to work out, and they're continuing. Look, experiences are up, other things are good, but there's some negatives in here, and that's what's happening. Yeah,
the YouTube TV thing's interesting. It happens to be where I get my TV, so I obviously noticed it. You walk away, hey, where's ESPN? The game's not, that kind of thing stands out to you as opposed to maybe some other networks. Here's YouTube TV's latest. Despite our best efforts, we've not been able to reach a fair deal. And starting today, Disney programming will not be available. It means you'll no longer be able to watch channels like ABC and ESPN or access recordings from these networks in your library, which is one of the big features YouTube TV has. They've given people like a $20 credit, I think, but where's the risk here? For Google, which owns YouTube, for Disney, I mean, how do you see this story? These things don't usually, when they're this high profile, drag on. Usually they, a little bit, and then there's a deal, but this one not yet.
Yeah, I mean, it happens with all the major networks at some point because the networks want to get more revenue from the provider of the cable company or satellite or streaming in this case, and they don't want to pay it because then they have to raise the cost to the consumer. So it's that battle every so often when the deals sort of run their course. They might be a couple-of-year deal, so it's very normal to renegotiate, and they're trying to do the same thing they're doing here with the other networks, and it's just about trying to keep the costs down overall and not paying too much. At the end of the day, if it goes on too long, then the YouTube TV risks people going to other things like DirecTV Stream and other places.
Right. Or just getting rid of the bundle kind of altogether, or the way. That's always been my question about this, is like, because think about it, what we've done. You mentioned DirecTV Streaming, and there's all kinds of, Hulu has their own, YouTube, Fubo, all these places. What we've kind of done, obviously there's been some people who just got rid of cable altogether, or bundles like this altogether, but we've kind of done is taken the cable, cut the cord, and then created this streaming universe where you'll be watching us on YouTube TV right now, right? But the question is that going to be what we continue with, or is there come this whole new ecosystem? I thought when ESPN went direct to consumer, that might change the model completely, but I don't think it has yet.
It seems like that's the world we're living in. Now someone will recommend a show to you, and the next question you ask is, well, what is it on? Because, there are 5 or 6 different things it's on, and you may or may not have all of them at any given point. So I think that's what's really happened here. And we did cut the cord, and where everything was consolidating, we were paying a lot. Now we sort of separated it all out, and now we're putting it back together to kind of get the same experience. So I don't know if we've really made any headway overall, and everything is just all over the place. So eventually I think it sort of settles in. But a lot of the younger people, they don't even do this anymore. They just get sporadic
That's
things.
The risk for big media companies, people like us, but also companies like Disney that have a bunch of networks. Is that at some point people would just say, all right, I'm good with Netflix, and I'll go direct to ESPN and bundle it with Fox Sports or whatever for my games, and that's it. I don't need these other channels. But you don't think we're there yet?
I don't think so. I think it's still trying to figure it out, and everybody's sort of figuring it out for themselves. And you can't borrow anybody else's password anymore, so that cut down a lot of that too. So.
Yes, it did. I know. It's like, yeah, so I have to get on my parents for that. Usually it's the other way around, by the way. You know, people borrowing from my parents. My case is my parents borrowing my password. Enough, get out. I'm kidding. Now, last thing before you go. This guy we talked about on the show, I think it was last week or the week before. Everybody remembers the Michael Lewis book, Big Short. This guy, Michael Burry, was the guy who bet against the housing market, and he made a ton of dough. All right, is shorting it. Now he's deregistering, terminating his hedge fund. Should we read anything into this, you know, for the broader world and markets, sir?
Yeah, you should actually. You know, hedge funds, I don't know if people really understand how they work and why this would happen. It's pretty common. And what happens is not only do they charge typically a 2% management fee, but they also charge a big incentive fee, and that could be 20% of the profit. So if the hedge fund's up 25%, they're going to take 20% of that, so another 5% on top of the 2% management fee. And so what happens is, the big thing is, well, we only charge it if we are higher than the point we were in the past. And what happens is if you make a lot of bad bets, which is what happened here, he shorted a lot of the tech stocks because he's been predicting a downturn for years. And, you know, eventually you're right, but if you do it too early or too often or too big, you lost a lot of money. And so if you're down 70, 80% in your hedge fund, you're probably never coming back to the high water mark that you were at before. And so what do? They shut it down, distribute the money, and in a couple of months they'll come out with hedge fund number 2
of course,
and start all over again with a new incentive.
Exactly. Okay. Interesting. So if you're buying a stock, there's a limit to how much you could lose. The stock could go to 0. But that's always the thing when you're shorting something. There's no limit on how much you could lose, which is scary. You can make a lot too. Doug, thank you. Doug Flynn, 4 p.m. Eastern is when